Welcome, everyone. We are having this series of conversations with Professor Shane from Biola University. They're all fintech related, very much touching a lot of our concerns in our daily finances. Today, we're going to talk about mortgages and buying a and basically doing a deep dive into mortgage lending. So Shane, as always, thank you for joining us. It's really a pleasure having you here.
Yeah, my pleasure. Happy to be here.
Awesome. So again, today we're going to talk about mortgages, right? And lending, doing that deep dive. And well, one of the questions is that everybody has is, okay, I want to buy a house. The main question is, what do I need to buy a house? What should I do? So we'd love to learn more from your experience. What do I need to do and what do I need to have if I want to buy a house?
Yeah, that's a good question. I went through the home buying process about 6 years ago, and it's a whole world of kind of new language, new terms. And so I think the first thing I want to just kind of talk about is defining some of the terms of home buying. The first being, most people can't afford a house by paying cash. So you don't just go to a house and you don't just like have a bunch of cash and you buy the house. Most people need to borrow. And when you want to borrow money to buy a home, usually you get what's called a mortgage. And the mortgage is an interesting device. Some say it's one of the greatest financial fintech inventions of all time. And prior to the mortgage, if someone wanted to borrow money, it was going to be like a 3 to 5 year loan. And often, homes were, if you weren't able to get enough money, and if you did get enough money, it was really hard to pay it back over that short of a time period. But banks didn't want to lend money over a longer period of time because that's more risky. And so what the mortgage did was it said, let's figure out a way we can borrow or lend to someone to buy a home over a 30-year process. And so you created this 30-year loan. And so the two standard or conventional mortgage loans are 15-year and 30-year. Mortgage itself is an interesting word. It's a word that has two kind of roots to it. So you got mort, which means death, and then you got gage, which means commitment. And so essentially the idea is it's a death pledge. And the image that you get kind of in the Latin is this idea of a knight throwing down his gauntlet saying, I will fulfill my commitment, otherwise, and if I don't, I will die. And so the mortgage root meaning is actually kind of severe. And so we need to recognize that there is this kind of, it's a bit of a marvel, this idea that you can borrow money and then not have to pay it back for 30 years. And so banks really, the government stepped in and they helped create a structure where there'd be some, help if there was any trouble, and the banks were able to kind of feel comfortable after they restructured the banking industry to provide a mortgage. And so you get your mortgage from the bank, and I'll go through a little bit about what they require. But first I want to talk a little bit more about how a mortgage works. They'll always quote you an APR rate, which stands for annual percentage rate. And by law, you have to quote an interest rate in annual terms. So if you'll never hear someone quote an interest rate that's not annual, and that's because the law requires it. Just because if you quote like a daily rate or a weekly rate, you can really manipulate people. So they have to quote an annual rate. So that's APR. The rate can be fixed or variable. If it's fixed, that's the ultimate dream, is you get handed a loan that's a 30-year fixed. And that means that the rate will stay fixed over 30 years. And if the rate is a reasonable rate, then no matter what happens with inflation, your rate stays low. So I just locked in a rate at 2.99% for 30 years. Rates are something you can refinance, and that's what it means to refinance, is if rates have gone lower than your initial rate they gave you, you can go to another bank and they give you the original loan amount, you repay that original loan, and then you get a new loan with a new bank and they give you a lower rate.
Yeah.
And there's usually a fee associated with that. But the market was so crazy last year that they actually paid, the new bank paid all of the fees for the old bank. And so I got to kind of refinance for free. So I brought my rate down to 2.99. And what that essentially means is I pay a fixed payment for 30 years every month that won't go up no matter what inflation does. And so my home is going to get cheaper and cheaper as inflation goes up, because my income is probably going to go up, but not the mortgage. So fixed rates are great. Variable rates are really nice if interest rates are high, because then you're hoping that interest rates will go down and you can naturally have a lower payment every month. But for the most part, variable rates are kind of scary, just because your mortgage payment can change every month.
I remember that on the 2008, some people had those variable rate loans and they got into trouble, right? Like basically banks.
Yeah. Yeah, and the way that the 2008 crash, a really pernicious predatory type of loan is called an ARM loan. Stands for adjustable rate mortgage, and it's not just a variable rate. It's a rate. It's a mortgage that's fixed for a certain amount of years, and then it switches to variable. And so what the salespeople would go to knock on a house and say, you know, you're renting. Wouldn't you love to own this large mansion over here in Florida? And they said, you can get in and buy this thing for, you know, only $800 a month. And what they don't tell them is that's a 5-1 ARM, which means it's 5 years fixed. And then once it goes to variable, it goes from 800, it can go, you know, 10 times higher. So their monthly mortgage could go from $800 to $3,000. And so after 5 years, you know, so 2007, they sold all these ARMs, and then everyone was waiting for 2012 when the ARMs reset. And that was a huge moment where all these homes kind of foreclosed. And so they said, hey, don't worry about the reset, because the home will go up in value so much that you can just, you know, cash in on that increase in value. And the home prices did not go up, they crashed. So the ARMs, there's most of them are 5-1, some are 7-1, which means 7-year fixed at a low monthly payment. And then it resets to a really high payment after that, unless interest rates have come down, and then maybe but even then, usually it's a really low fixed number. That's not really, you're just paying interest. You're not really paying back the loan at all. And then, so the ARM ones can be appropriate if you know what you're doing. But it's one of those, like, not very often is it appropriate.
Yeah. You really need to know what they're doing there. Yes. Yeah. And I remember also when doing APR that it's really interesting, because they tell you this is the interest, but actually the APR can be high, like very close or really high compared to the interest. And I think there's something related to fees, right? Like based on what.
Yeah. So they'll give you an interest. The loan has an interest cost to it that the bank is charging, and then there's some extra little fees that get baked into the cost, and so the APR is usually a little bit higher. Hopefully, there's not a huge difference between the interest costs and the APR, but yeah, and so usually, if you want to get a mortgage, the big mistake people make is they just go to their bank and try and get one there. You usually, if you go to a bank, a commercial bank, any kind of place that has a captive audience, they'll usually sell things at really bad rates. So they'll give you a high interest cost, because they're just taking advantage that that their clients don't necessarily know much. And so you never really want to go, and you don't want to do like Rocket Mortgage and do an app. You know, it's really better to work with what's called a mortgage broker. And a mortgage broker, they'll work for you for free, and they'll pre-qualify you for a mortgage, which means they'll look at your income, they'll look at your all of your financials, and if you get pre-qualified, then you can start house shopping. And then the moment you see something you like, if you're pre-qualified, you can put in an offer much quicker. And so the broker what's nice about this person is that they have relationships with all of the banks,
Yeah.
and then they get the banks in a bidding frenzy.
Yeah.
And so usually you'll get kind of a much lower rate than if you just went to one bank. You'd rather have all the banks bidding for your business, and the banks pay the broker for their services. You never have to pay the broker, which is great. And so it's just like a nice way of shopping. And so you want to choose a good broker. There are dangerous brokers who may take advantage of their position. So like for me, I found a real estate agent that I liked, and he had a broker that he liked, and it was all within a trusted community. And so the idea of being pre-qualified for a mortgage, the main requirement that they're looking for is how much of your income would be taken up by that mortgage payment.
Yeah.
So the magic number is 28%. So you don't want it to be more than 28%.
Yeah.
And the mortgage payment isn't just the payment of the mortgage, it's actually, they add property taxes, which is different in every state, but it's usually about 1% of the loan balance, or of the property value, I should say.
Yeah.
And they'll also add homeowners insurance, and then they'll add this type of other insurance called PMI, which is oh man, I'm blanking on PMI. It's the insurance for if you don't give 20% down payment. So when you're buying a house, you can, let's say the house costs $500,000, you can get a loan for $500,000, and then the bank gives you that $500,000, you buy the house. But most people want a down payment, and most banks will want a down payment, which means you put skin in the game. You contribute $100,000, you contribute. So if you did $100,000, that would be 20% down payment for a $500,000 home. And sorry, go ahead.
I have a question here on that side, because you touch a couple of really important points. One of them is one of the common misconceptions when we were buying our house was that, like, basically, okay, I have the down payment and then I can pay this amount, but they were checking, hey, actually, yeah, we need to add all this, and you need to have this reserve, this amount of money after you kind of pay the down payment. So it's the down payment plus some money, so we know that you're able to survive for a while. So that's when we started to discussing, okay, well, how much down payment should we give? And then the PMI came into the equation, right? Where we're like, okay, if we give less, it's good because we have more reserve, but then at the same time, more monthly. So we'd love your thoughts there. Like, do you recommend like going 20%, lower than 20%? I know for some people it's hard to have 20% of a down payment, so we'll love your thoughts there.
Yeah, the magic of 20% is that you eliminate the PMI payment, which could be, $500-$600 a month extra. And but the other really good thing, so there's two other benefits for 20%. The second benefit is you get a lower mortgage cost. So you actually get a lower rate. And so the bank likes 20%, and they'll give you a lower rate because they have less risk of you not paying them. Yeah. And the third, and this is probably the most important in today's world, is that you won't get a house. So no buyer, they get 5 offers the moment they list their house, and they just eliminate anyone who doesn't have 20% down payment.
Oh, wow. Okay.
So, and they're used to now people having more, 30, 40, all cash, that kind of stuff. And so you're not really competitive anymore in the housing market if you don't have 20%. So for all those reasons, it's nice. And then 20% lets you have some equity that you can draw from. So if it acts as a kind of emergency fund, you can, go to the bank again and say, hey, I have this 20%. Can I get a loan from that? And so you only do that. And I actually drew from our 20% when we needed to buy our air conditioning unit. Because that was $20,000, and I'm like, I don't have and so we could just get an extra little loan where they know that it's safe because we have all this money, our money, in the house. And so yes, I think there's just a lot of nice benefits. The only problem is if you're in California or you're in just any high cost area, 20% means $200,000 or more, and no one has that. The only reason I had is because my in-laws had bought, during the Great Depression, and so they had built up some wealth, and so they helped us. But you can, if you don't have 20%, you can still qualify for a mortgage as low as 3%. And if you do FHA, Federal Housing Authority, then you can qualify for a mortgage with a low credit score as well. And you can have your score be as low as 580, which is pretty low. You can get a loan up to 800,000 with FHA. The FHA, the cons is that the PMI insurance premium that you pay per month is going to be higher. And they're also, you're less competitive when you're bidding, because people don't like if you're financing using FHA, because there's an extra approval process that the government's involved in, and no one wants that, you know. And then there's a little less flexibility in what you can buy. So if you want a 0% down with no extra PMI, then if the VA loans are incredible. So if you have any military background, you can qualify for that. And then if you live in a rural area, you can get a USDA loan, which is 0% down, but that you have to qualify in that you don't have any decent, safe, or sanitary housing options, and then they'll give you a 0% down mortgage.
I have a question, like if top of your mind, like if I could do a checklist of what are the things if I want to buy a mortgage that is kind of like vanilla for for the bank.
Yeah.
What is kind of like what they're looking for?
Yeah, I had my checklist, so I didn't think I'd be owning. I just didn't think it was, because I'm in Los Angeles, and right now, if you look at affordability statistics, LA is the worst in the entire country. And so I thought it was just not possible, but I had 4 requirements for owning. The first, I needed to have a stable income. And so people often ask me, you know, should I buy when housing prices are record highs? And to me, it's mostly a function of, do you have stable income? Because as long as you can feel like you'll be in your job for over 10 years, you can wait out the house crashing. Because the worst thing is that if you buy at peak prices and then you lose your job and you have to move, then you're in trouble. But if you feel like you have stable income, whether it is independent contractor or W-2, but just like income from a job that's stable, then, you know, for me, I didn't have stable income for a while because I was changing careers from an investing job to a professor job. And the moment I felt kind of settled in my professor job and I felt like I wasn't going anywhere, then I was like, oh, you know, I feel like I want to be here for a long time. So I checked that box. The second one is a stable family situation. Family is really, really important to check this box. My wife, when in 2007, she bought, everyone was buying homes and everyone's getting rich. And so they all pressured her they're like, if you're renting, you're wasting your money. And so she bought a condo with her best friend, and they were both single, and with the help of their parents. And the moment they did that, her best friend met a guy who lived in Boston. She was in Seattle, and they immediately got married, and the best friend left and went to Boston. And so she was alone in this house, and she had to fight to pay every payment and bring roommates in. And then she got married later, and I was in California. And so it was a huge problem to have this house. And it was still underwater, which means, you know, she owed more than what the home price was worth. And so anyway, so for me, the other box I want to check is that I was married and had kids, because the moment you have kids, you're not going to be just jumping around. Kids really are a bit of an anchor in a good way, because you want them to be at the same schools. You want them to be near, you know, your grandparents and all these kind of things. And that's not a requirement, but it's just the more stable you are in your family, the more likely it's just great to have a home that you own, that you're kind of nesting in. So, you know, I got married, we were renting, we had our first kid, and then we had a second kid on the way. And I'm like, oh, you know, this is really good. Like, I'm very stable right now with my family. So that box got checked. The 20% down payment was kind of a requirement. I really wanted to have 20% down for the 3 reasons we had said. I didn't think I'd ever have that kind of savings, because I needed to have 200,000 for that to be possible. And then, you know, my parents weren't going to be able to help really much on that front. And then we ended up just kind of randomly asking her parents one day, and they agreed. And so we're like, oh, and so then check that box. And then, and then the last box to check is that, I want to get a good mortgage rate. I don't want to have an expensive mortgage. I don't want to get locked in at a really high rate. And so I wanted to make sure that my housing payment was less than 28% of my gross income. So you take your paycheck, and then you figure out how much you're going to pay in housing, including property taxes, PMI, and homeowners insurance, which tends to be around $200-300. And if you have any other types of fees, like if you live in a complex and there's HOA fees and all that kind of stuff, you have to add that as well. And I was right at 28%. So I was going to get pre-qualified well. My credit score was good. I was going to get a good rate, and I was going to be competitive to get a good home with our 20%. And I was going to have stable income. So even if the home prices crashed, I felt like I could weather it out. So all of those boxes checked. And then I felt like it was probably a pretty good time to buy in. It was not a good time price-wise, even though, because it was at extremely high levels. And then since we bought 6 years ago, it's at even higher levels. And it's just kind of monopoly money at this point. The last thing I'll say, what some people need to understand about when you rent. So people just, a common myth about home owning is that you're just kind of flushing money down the toilet every month. And that really aggravates people. And it causes people to get crazy because they're just like, I don't want to flush my money down the toilet. And there's 3 benefits to renting that homeowners don't have that I just think need to be incorporated so that you understand there is something you're benefiting from. One of the most important things you have is nimbleness. It's this idea that you can go anywhere, be anywhere. You can go to any job. You can go to any state, any country. Really, you don't have to be, being a landlord or a property manager is exhausting, and you can just live in much better places. Usually, if you own a home, you have to go far away and have a long commute. And even though that formula is changing with COVID, post-COVID, but so you're much more nimble to kind of be lots of different places. I lived near the city, or I lived near the beach, or I lived in fun places near friends, and that you just can't own a home near the beach when you just can't. But you could possibly rent. And the second thing is people don't realize how expensive owning a home is. So they look at just this mortgage payment and they think, oh, that's cheaper than my rent. How dare society have it this way? But really, if you add up, so property taxes, for me, for the median California home, it's $800 per month that's added to that payment. Homeowners insurance is around $200-300 extra. Water and trash is expensive. So, when you pay water and trash, that can be up to $500 a month you're adding. Handyman work is very expensive. There's no landlord that's going to come and fix anything. And so our toilet's just plugged again, and that's hundreds of dollars going out all the time. We had to replace our AC and our heater. That was $20,000 that just left, goodbye. And our roof, every 10 to 15 years, that's another 10 to 20,000. Plumbing, every couple of years we're spending a couple grand on that. We just had some pest problems. That was a couple grand to deal with that. It's kind of like you're just like, money just goes. And it's an investment. But if you are cash flow strapped, if you don't have a lot of extra cash flow, we have some extra cash flow that we can contribute for this, then you actually save hundreds of thousands of dollars over. So I made one calculation that you can save almost $100,000 by renting versus owning over a 6-year period. And so again, if you look at your life situation, if you don't have extra cash flow around, it is much more expensive to own. Just all these costs just keep rearing.
Yeah.
But over a 30-year period, you make a lot more money owning. Yeah. Because home prices go up, and the home price, is such a big amount of money that you can cash in on that. So yeah, the last thing you get when you rent is, so you get nimbleness, you get a little bit extra cash in your pocket, but you also get time. Owning a house is a time sucker. It's every day I go home, there's something I need to do. There's always something I need to do,
Yeah.
and so it just takes a lot of time to manage the house, and it's fun. The gardening. We redid our garden. You have to repair things. We're putting in solar panels. There's something fun about that, but there's also a lot of time. And so, yeah, I find myself spending tons of time. Whereas when you rent, you just kind of like, you can never be home and it's totally fine and nothing goes wrong. But yeah, so you get those benefits, and that's a nice thing about renting. But if you can check those 4 boxes, then I think buying is better.
Yeah.
But if you can't check them, there are some really nice benefits to renting that should be acknowledged. It's like, it's okay.
Totally, totally. Yeah, I think that's super important. And I know we are over time, but one of the things though that I noticed when owning a house, or at least the bank owns it and we are paying them. I don't know.
Yeah.
I don't know how to qualify that. Is that as you're mentioning, although it takes time, it's also that sense of ownership. I've noticed both my wife and I that it's kind of like you feel that's your place. But I think you touch one of the points that I've never considered is that part that stable family, that sense of you don't want to move necessarily. That was one of the things that gave us, okay, this is the place. We do our gardening super happy, like we do some projects, but because we don't have any plans of selling anything, or we don't see it necessarily as an investment, but our place, and the place for the family, right? So
Yeah.
super interesting. Cool. I think, well, we are definitely on time. This was a very interesting conversation. I mean, we have more to talk about other subjects. We're going to talk about investment. We're going to talk about budgeting. We're going to talk about growing wealth as well, for example. So this is going to be a really interesting series of conversation. Thank you, Shane, for making the time again, and looking forward to our next conversation.